Seems you're caught in a catch-22 now, where you have to work both sides of this to keep interest rates abnormally low, and you have to continue to buy treasuries, or we'll be paying so much on our national debt that the fiscal problems we're looking at will complicate overnight.
I would question whether or not low interest rates are in some way enabling fiscal deficits. If we were to raise interest rates by a full percentage point, that would still only raise the annual deficit by something over $100 billion. So
there's Ben Bernanke on the hot seat in Congress today. Welcome to Main Street. I'm Dennis Berman of the Wall Street Journal. The chairman of the Federal Reserve answering to some congressional critics, trying to explain how the Fed is balancing those ever difficult tasks of full employment and interest rates. Brenda Cronin from the Journal's Economics Department is here to join us.
Yes.
Always great theater when Bernanke's on the Hill. How would you rate today's performance?
Oh, well, I would rate today's performance in letter terms as an A, in that the chairman did precisely what he's supposed to do, which is that
obfuscate.
Well, he didn't give away any secrets, that's for sure.
Right.
But then as the chairman of the Federal Reserve, he's not meant to do that. And other speakers from the Federal Reserve who are out speaking today and earlier this week perhaps gave a few more hints about how Fed policymakers are thinking. Bernanke, no matter what the bait was from the questioners, didn't really seem to take it.
Of course, Janet Yellen earlier in the week gave markets some hope that there might be some further Fed easing or quantitative easing with her comments. As a good Fed watcher that you are, Brenda,
that's right.
if you could try to parse the best that you could, even his non-statements, did you see any real signs in there?
I saw a few interesting aspects. One is, first of all, very obvious concern about Europe. That was very, very clear. And that also was very clear in the Fed's beige book yesterday, that districts, even though districts are seeing some of their economics improving just slightly and moderate economic growth, Europe remains a big concern. So we heard that again today, too, from the chairman. We also heard that we may be seeing some payback now in the jobs market for the big gains earlier in the year, translating now into sort of less exciting gains.
I love Bernanke. He cited the weather. He was like a bad CEO who said, oh, you know, Christmas sales, not what they really were. There was too much snow. This case, it was too warm. It was a little lame, I thought, the weather line. It was a little lame.
We'll see how it plays out. But he also used a lot of the sort of fiscal cudgel, kept urging lawmakers when they would push at him, he would push back and say, we need some fiscal responsibility. So I think that it wasn't a non-message warning, which is what some interpreters
Now, we did get a message from halfway around the world in China.
Big time.
The Chinese central bank cut their rates by a quarter of a point.
Quarter of a percentage point. So did India not all that long ago. This is a watershed. This is a very, very big deal. It's also an indication that China is seeing some need to ease money, to stimulate the economy just a little bit. And we're seeing ripple effects of this throughout the world, and we will see even more of them tomorrow morning with the trade report.
It seemed that Bernanke's comments about Chinese growth, he painted it simplistically.
He seemed pretty bullish on China.
It seemed like he painted it simplistically. Oh, you know, a reduction in Chinese growth brings down oil prices, which are good for the U.S. economy. Would you say net, Brenda, that Chinese growth is probably actually good for the U.S. economy?
Yes.
I mean, as a net buyer of everything we make?
Of everything from flip-flops to speakers, yes, I think so. I think that was a very simple way to deliver the message that some consumers in the U.S. are not feeling so bad because they're seeing cheaper oil, so they have more money in their pocket to buy other stuff. And we are seeing that, but I think that the notion that China sort of slowing off, that is not good news for the United States. You'll see this maybe not in tomorrow's exports, which are from April, but you'll see it down the line. And also China itself is worried about weak demand from U.S. consumers.
As we've seen, China is the marginal buyer of pretty much everything that this earth has to offer, be it copper, electronics, airplanes, nuclear power plants.
From commodities to very expensive cars. So if they are seeing a need to do sort of a stealth stimulus, then that is something to take note of.
Right. Well, I'm shocked that Congress did not take credit for lower oil prices. They seem to suggest that politicians control the price of oil. You mean politicians don't control the price of oil? I thought. No, they don't. Any last thoughts, particularly about the mood in Washington that you're picking up on? It seems like we're obviously waiting for the election and then waiting for the fiscal cliff at the end of 2012.
Well, more immediately, we're waiting for the next FOMC meeting later this month. And we're also waiting for the Greek elections on the 17th of June, which will really show where things stand in two key economies in the world, in the Eurozone and the United States.
Right, okay. So Another summer of, I don't
Watch
know.
and wait.
Watch
Let's hope
and
it's
wait.
not like last summer.
You know it will be. It's only, you know.
We do not. No government. We came near a government shutdown. We're not going to do that.
It's
again.
not, well, it's not going to be like last summer. It's going to be worse because the fate of
great.
Europe is going to be hanging, despite, you know, incremental moves by central banks. There's still the central issue that needs to be resolved.
But watch central banks take a cue from China and perhaps do something.
Okay.
I mean, in Europe and in England, not just in the Fed.